Good afternoon, ladies and gentlemen. My name is Michalis, and I'm the market analyst here at HF Markets. And I'd like to welcome everybody to our third webinar. I'd like to first thank everybody on their comments, which were sent through via email, through our chat, through the GoToWebinar software, also on YouTube as well. A lot of great feedback. I'm really glad that the information which is being passed on was something which was extremely helpful. I'm very happy about that. Also, a lot of people sent through saying this is one of the best webinars that they've ever seen. So I'm really, really glad about that. And what I've decided to do is continue the topic that we were looking at last week, because we also had a lot of individuals who said, this was such a helpful webinar. Please, can we have more webinars like this? And I'm a believer that if you're going to look at a topic, brokers and educators and so on and so forth, they tend to go into the bad habit of they look at a topic, they speak about it for 45 minutes, and then they don't look at it again for 2, 3, 4 months. So I'm a believer that we should be looking more at a webinar series, in which case it's a much more easier learning curve. So in our last webinar, we spoke about how to improve the timing of your trade exit, whereas today we're going to be referring to your trade timing. So we're not only going to be referring to trade exits, but also to trade entries as well. Today is a webinar which is largely designed for beginner traders. When I say beginner traders, we're referring to individuals who potentially have never traded before, but also to individuals who have been trading with some experience, but not necessarily an experienced trader. So maybe been traded 2, 3, 4 months, for example. Now, in our last webinar where we were referring to the trade exit, we were looking at different techniques which involved the measurements, mathematics. We looked at techniques such as scaling in, scaling out. We looked at, for example, one of the slides which got the best feedback was how we can look at the mathematics behind trading to see what type of trading plan and exit is required in order for you to be potentially a successful trader, whether you, for example, have a very high success rate or have a very low success rate. So if there's somebody who is very new to the financial trading market and maybe has a very low success rate, so they are unable to determine how the market is likely to move, then we have a success rate of 30%. So out of 10 trades, only 3 of those trades, they are actually closing in a profit. How potentially they can change the mathematics behind trading in order to still be a profitable trader, regardless of the fact that they have a low success rate. So this is something which, of course, we look at in the financial market when we're looking at institutional levels. But of course, there's not a lot of individuals who are providing this educational material because everybody's looking mainly at YouTube, webinars, seminars, whereas this has gone slightly more advanced. So it's great that I've got the opportunity to pass on this information to everybody. Now, as part of today's webinar, because we're still very early on in our webinar series, this is only our third webinar. So I've got a question here, so let me quickly answer this question. What is the name of the webinar you did last week? I'd like to review it. Yes, of course. It was, I'll confirm the exact title, but it was how to improve your trade exit, the timing of your trade exit. Today we're looking at trade timing in general. You can also find the webinar recording, of course, on YouTube and also on our website. Now, because this is still one of my first webinars, we're still very early on in our webinar series, I will do an introduction as well for those individuals, because I can see a lot of questions here. Tell us a little bit about yourself. Look, even though myself, it's not important to your success. It's not important to how great and successful you are as a trader. But yes, I do understand it is important to know a little bit about the individual who's providing you with this information. So of course, I have included a slide there. But of course, I want to go through the introduction as quickly as possible so we can start looking at what is actually going to make a difference to the way that you're looking at the financial trading markets. Now, as part of this slide, I just want everybody to be aware that, of course, here at HFM, we are dealing with investments. Now, as with all investments, no matter what the investment may be, people may be trading stocks, ETFs, bonds, whatever it may be, FX, indices, cryptocurrencies, whatever it may be, they are all investments. And as with all investments, there's a risk to the capital that you are investing. Of course, we have no control over how the price is likely to move. So, of course, you have to understand this. You have to be comfortable with this before proceeding to a full investment. Will there be a handout for this webinar? If you're referring to the slides, yes, of course, we will make a copy available to you. Now, the last thing I'll say as part of this slide here is that, of course, this webinar is not here to give investment advice. So a little bit about myself as promised. My name is Michalis. I am the market analyst here at HFM. Now, I've been in the financial trading markets for almost 10 years now. Originally, I was in London as a financial advisor, which I was for between 4 to 5 years, almost 5 years. And I've been a market analyst now for 6 years. So I've been investing and educating in my role in London. I was an actual advisor for almost 10 years now. So I've been an experienced market analyst. Today's webinar is largely based and designed for beginners, but as our webinar series continues, we will start to look at more advanced trading tools which are being used by large institutions like Goldman Sachs, like JP Morgan, but that nobody is actually speaking about, because I do a lot of research to see what everybody is trying to learn from YouTube and these educators, and a lot of the things is very basic. A lot of the time it's things which don't actually work. So slowly we will start to look at more advanced tools which are being used by the larger market players. I've got a question, what type of tools? Okay, so I can give you some examples. There's tools such as the volume weighted average price, which is a much more accurate version of a moving average, much more accurate version. That is the volume weighted average price. There's also other tools even more advanced, such as delta statistics, such as cumulative delta, order flow charts, and so on and so forth. Now, of course, what I want to say as part of this slide is, yes, we of course want to provide as much assistance as possible, but we will not give investment or financial advice. What we do want to give, though, is as much educational material as possible in order for you to be active in the financial trading market with knowledge, with experience, with expertise, in order for you to be confidently active on your account as you personally wish and seem fit. So why is trade timing so vital? Today we're going to be looking at trade timing. Now, what we're going to be looking at as part of today, and this is something that we got a lot of questions about after last week's webinar. You know, people said, you know, I understand now so much about what I need to think about, what kind of decision-making process I need to potentially take before closing a trade. But I'm still struggling with my entry. Now, when I'm speaking to these individuals, they say, you know, I can look at a chart, I can look at the longer term trend. So for example, this year, I can see that we're in a bullish trend in the stock market. We've been in a bullish trend now for weeks and weeks. But even though I'm able to identify the trend, I'm still struggling with the timing of the trade. Last week's webinar, we were looking at exiting. Today, we're going to be looking at entering. So even though I'm able to establish the trend, how can I improve my timing? Because there's still volatility within the market. So the issue with that is, even though we're trading in the right direction, if we're trading at the wrong point within the market, you still can potentially be hitting your stop loss. So I can give you an example of this, ladies and gentlemen. Here we can very clearly see, it's not important what asset this is, ladies and gentlemen. So 4-hour chart, we can definitely see some upward trend. If I'm trading at this point here in the market, I'm most probably going to close the trade. I'm putting myself, by the way, in your shoes. So if I'm placing a stop loss, if I'm going to start to see the market move against me for 6 hours, for 8 hours, for 12 hours, as a beginner, somebody with not a lot of experience, most likely you will close the trade or have to close the trade because of insufficient funds. So the issue here is you've opened the trade, you've analyzed the market, you've made a decision, you've opened the trade to speculate the price increasing. The direction is correct, the trend is correct, but your timing is poor. So the issue is that when you've opened the trade, we've suddenly fallen into a retracement, you've closed the trade, and then the market starts moving in your favor. Whereas we need to avoid this and enter in this area of the market. So we're going to be looking at different techniques in which we can improve our entry, and improve our trade timing. So what is the issue with trade timing? Why is it vital? Number one, because, and we have to keep in mind, we've got people from all around the world and people with all different leverages. Some people have a very, very high leverage. Some people are using a leverage of 1 to 2,000. Some people may be using a lower leverage of 1 to 30 or 1 to 20. So this is just an example. But if somebody's using a very high leverage, then it's like volatility is significantly increasing. So because the volatility is increasing, the timing of the trade is more important. Whereas individuals with lower leverage, or if somebody's maybe potentially trading with no leverage, the timing is not as important as the direction in which they are speculating. Now, the issue is that if you trade too early, you are actually trading against the trend. But if you trade too late, you're running the risk of either entering at a retracement, at a correction, or at the end of the trend. So an example, if you're trading too early, ladies and gentlemen, let's take, for example, say we want to take advantage of this upward price movement here. If you're trading too early, you're trading, for example, here at this point here in the market. The issue here, ladies and gentlemen, is that the market is still moving against you. If you're placing a stop loss, potentially you're going to hit your stop loss. Whereas if you're trading too late, ladies and gentlemen, let's say you're trading here, keep in mind this is a 4-hour chart. If you're trading here, ladies and gentlemen, and speculate the price is going to be increasing in value, then we're actually in a minus for 1, 2, 3, 4, 5, 6, 7, 8, 9 hours, ladies and gentlemen. So for a day and a half, for 36 hours, the trade is going to be in the minus. And especially if we're an intraday trader, we want to, of course, avoid overnight fees, which are known as swaps. So you can really see here why it's vital that the timing of the trade, yes, of course, it is important that we trade it in the right direction. And we're going to, of course, be looking at this throughout our webinar series. There's going to be specific webinars that are designed to show you how you can, by yourselves, analyze the market to potentially identify the potential direction of the market. But today, we're not going to be focusing necessarily on the direction, but we're going to be focusing on trade timing. Now, the first thing I want to mention is the breakout. And the second thing I want to mention is the second impulse wave. And I've got a slide that we're actually going to look at the second impulse wave in more detail. Now, the breakout is something that I mentioned last time, and people said to me, please, can we look at the breakout again? And keep in mind, we're not going to be speaking about breakouts like all other educators speak about breakouts, because there's so many videos online which are saying trade the breakouts and you'll be an amazing trader. It's not correct. It is incorrect, 100% incorrect. And I'll explain exactly why as well. So we're going to speak. People said to me, let's please look at the breakout again, at why it's incorrect, how we can improve that. People said to me, if we can look at the mathematics around trading and the wave measurements. I don't want this webinar to be the exact same as the last webinar. So we're not going to look at mathematics today because today's webinar is more for beginner traders, and we don't want to gives so much information and it's going to be difficult to follow. But we will look at measurements and the breakout. Now, people online, they will continuously say to you, trade the breakout. So when you're looking at an upward trend, and okay, this is correct. An upward trend is officially higher highs and higher lows. This is correct 100%. So when you're looking at a trend, this is for an example, an upward trend. We have an impulse wave, which is a price movement in the direction of the trend. We have another impulse wave here, and we also have another impulse wave here. And then we have the corrective waves, which can be corrections or they can be retracements. Now, for it to be a trend, we need the impulse wave. So we need the green lines to be much larger than the red lines. If the green lines are larger than the red lines, then we have what is known as highs, and each high is higher. So you can see here are the highs, and on each occasion, the high of the wave is higher. And then we've got swing lows. So we can see the lows here, the low here, and also the low here. Again, we're looking at consecutively higher lows. And this is why we have an upward trend. Now, this is the only thing correct about breakouts. But in terms of how to open a trade, and of course, we don't give investment advice. We're not here to say how to trade, but we're going to show you in terms of education, why there's disadvantages to trade in the breakout, and why if you're trading before the breakout, there's much more advantages. So I've got another question here. Okay, so I've got somebody else here who says that was looking at videos online. He says most videos say to trade the breakout and it's not working for him. I've got some other comments here as well. Okay, I've got somebody else. He hasn't said he's watching videos online, but he says breakout's not working for him. So I've got another question. What is a correction and what is a retrace? So there's a difference between a retracement and a correction. When you've got a trend, if we're looking at an upward trend again, you get the impulse wave like so. Now, if we get a retracement, we get the price moving against the trend, but it's a smaller price movement. So it's not necessarily an issue because all trends have retracements. As long as it's a smaller price movement and the trend continues, it is what is known as a retracement. But if the price movement declines and it's a larger price movement, so it's actually gone to the previous low, so it's not a higher low, but it's the low's gone back to the same level or below, then it's actually a correction. So the difference is a correction is much larger than a retracement. Now, what is the issue with the breakouts? The issue is, ladies and gentlemen, is that you've established that you're in an upward trend because there's higher highs and higher lows. Okay, what individuals will say is draw a line, a black line or whatever color line you like on the previous high. So let's say this is the previous high here. This is the high before that. So if you're trading at this point, you would draw a line here like this and so on and so forth. So you're looking at the previous high. So I've drawn a black line here and they will say to you, as the price increases, as soon as it increases above this level here, then potentially open a trade and speculate the further price movement. This is what a lot of people say. There is a major disadvantage to this. Well, there's actually two major disadvantages. Number one is that you've missed all of this price movement here. You've missed so much of the price movement that you potentially could have been speculating and earning a profit on. The second thing is the breakout level is normally at 80% of the whole wave. So you've missed 80% of the whole wave and you're trading at the very end of the impulse wave. So the issue here, ladies and gentlemen, is that you're trading so late on within the trend, there is a higher possibility of you trading at the point, you're trading too late. The time of the trade is wrong and you're trading too late and there's actually about to be a price movement against you. And I will actually show you this on the charts as well, ladies and gentlemen. Actually, let's go to the previous chart so I can show you before we start to move at the next slide, because I don't want you to start reading and thinking about the next slide. This is the previous slide that we were looking at. So let's look at the previous high. This is the previous high here, ladies and gentlemen. So if I draw a line here, look at that. We've missed most of the price movement. All of this price movement here, we have missed. And there's only a very small piece of price movement that we can potentially benefit from. Now, if we use the previous high here, it's a much better trade. So if we look at the breakout here, we've got plenty of price movement here to be trading. Now, if we look at the previous high again, so for example, looking at this high here, or we may have even been looking at this area here, again, it's not much price movement for us to be trading, ladies and gentlemen. And there's a very big chance that we're going to be trading too late within the trend. So in order for us to be more accurate and better with our timing, ladies and gentlemen, what professional traders try and do a lot of the time is, yes, we're looking at higher highs and higher lows. If there is higher highs and higher lows, we've already established that we're in an upward trend. So we already know, let's say, for example, we cannot see this impulse wave. We already know as the price is declining here, we already know that even though the price is declining, we're in an upward trend. So we still have in mind that we're going to form another impulse wave. That, of course, we want to take advantage of. So as this price starts to increase in value, for example, here, then potentially we may start to take into consideration that we've seen enough movement in the direction of the trend, and we're starting to get closer to the breakout point, that potentially we're going to look at an opportunity that the price is going to increase and form another impulse wave. So the advantages of this, ladies and gentlemen, is you're not trading here, but you're trading below, ladies and gentlemen. You're trading, for example, here, in which case you've got a much larger price movement here, which you can take advantage of. There's a higher if there is an impulse wave, there's a higher possibility that your entry is going to be more beneficial if there is an impulse wave. I'm not saying trade before the breakout, don't think about anything else, don't analyze the market, and it's definitely going to be a profitable trade. I'm saying if there is an impulse wave which is going to form, if you're trading before the breakout, you most likely are going to be looking at better timing. Now, let's look at what we can do in order to help us to determine there's enough movement against the trend now for us to form the next retracement, the next impulse wave, and also that there's enough movement now in favor of the trend for the trend to actually continue. So in order to do this, we're going to measure continuously each and every wave. Now, some people are going to say to me, how do we measure the wave? If you go to the MT5, there is the cross tool, the cross button, which is next to the arrow button. If you click on that, ladies and gentlemen, you can click and drag and it will actually measure it for you. Some people are using percentages, especially individuals trading stocks and indices, whereas other people are using pip movements. If you're using the cross tool, it will give you a percentage, it will give you pips, it will give you pippets as well. So it's completely up to you. So what are we looking at here, ladies and gentlemen? First things first is we have a trend here. This is a trend. Firstly, and the reason why I picked this slide is because we're showing the end of the downward trend and the beginning of the upward trend. And this isn't a very old example. This was an example from just a couple of weeks ago. So first impulse wave here, ladies and gentlemen, was at 1%. The next impulse wave here was 1.47, and the next impulse wave, ladies and gentlemen, which is this impulse wave here, is 1.18. So I'm measuring each price movement, and as the price movements keep forming, as we get another retracement, I'll measure it again. As we get another retracement, another impulse wave, I will again measure it, and I'll show you exactly why this is very, very important. So let's look at our retracements. So this is a retracement here. Bear with me. This here is a retracement. Why? Because it's a downward trend and it moves upwards. So there's a retracement. Then the trend changes, and our next retracement is here. So this is the price movement against the trend. The first retracement was 0.60. Here we can see it's 0.51. Then we get the next retracement here, 0.57. Now, why am I doing this? Why am I measuring the price movement? Ladies and gentlemen, if you measure the price movement, you'll really start to understand the characteristics of the asset and the characteristics of the price movement. Now, if you're able to do so, then you've got an idea. It's not 100%, it's not guaranteed, but you've got an idea of what type of price movement potentially that you're going to see going forward. Now, if for this to be accurate, you're not going to measure the price movements this month, make a note of them, and then not measure it again, because the price movements in 6 months' time may be a completely different style, completely different characteristic. So each time there's a retracement, each time there's an impulse wave, we measure, measure, and measure again. So for example, what am I looking at here? If we're looking at the impulse wave, I've made a note that the largest wave in the direction of the trend was 1.47. The smallest was 1%. So if we're looking at an average, because we've got one wave here, we've got a second wave, and we've got a third wave. So we've got 3 waves. We look at an average of those 3, we're looking at 1.21%. So if now that we've had the retracement, so we can see here we had the retracement. If we were going to form another wave, then I know it's going to be somewhere between 1% potentially, and potentially 1.47, and then on average 1.21. And then if we're looking at a retracement, the largest retracement 0.60, the smallest was 0.51, and on average it's 0.56. So look at this, ladies and gentlemen. The retracements are almost identical, and nobody's measuring. If I'm going to speak to the people that are watching today's webinar and say to them, you know, how many of you are measuring the movements as you are trading? I guarantee you, none of you are going to say you're measuring the price movement. This is a real example, real measurements. Look at the retracement: 0.60, 0.51, 0.56. All of them are more or less identical. So I know, ladies and gentlemen, this is why it's important to measure. I know that if I'm looking at an impulse wave, an impulse wave is increasing in value. I know that as it starts to decline, even before the price movement happens, I know that it's potentially going to reach here as a very minimum, as a very high, it's going to reach here, and on average, it's going to reach here. I know even before the price movement that this is the range where the price movement is targeted if we continue to follow the traditional price movement. So let's say, for example, we form only a retracement, nothing more, it declines to here, and we start to get increase in price movement like this. Now, of course, we need to keep analyzing the market. We need to look at fundamentals. We need to look at order flow, etc. But I can see there's price movement upwards. The breakout level is here. Like I said, be careful about the breakout. Try and trade before the breakout to improve your timing. It doesn't mean as the price is declining, buy. So then you're trading against the market. Don't trade against the market. Unless, of course, this is your strategy and you want to trade against the market. But of course, it makes more sense to trade in the direction of the trend of the price movement. Which is why people continuously say the trend is your friend, or don't try and catch a falling knife, or stop trying to fish for the bottom. These are all phrases which are here for a reason. So of course, try and trade potentially earlier than the breakout level, which is here, for example. But I know even before the next wave in the direction of the trend starts or has only just started, I know that as a very minimum, it's going to increase to here. On average, it will increase to here. And as a high, it's going to increase to here. Now, if you are very, very low risk appetite, then you can say, I will look at the smallest wave, which is 1%, and I'll only trade 70% of it. So I'm only going to look to earn 0.70 and I'll exit the market because I've got a low risk appetite. This is just an example. You can amend that. You can have an ultra low risk appetite and say if it's 1%, then I'm going to look at half of it. For example, I've got another question here. So I've got an individual here. I'm not quite sure what the question is. If I use a higher leverage on a small account and a higher lot size, what should my expectations be? To be honest, this isn't necessarily related to this slide. Regardless of what your trade size is or your account size is, this still applies. In terms of your expectations, if you're referring to how long to stay within the trade, again, it's completely down to you. I cannot advise you how long to stay within the trade. But if, for example, if you're measuring the price movements and you're seeing that on average price movements are lasting 1%, then of course you need to keep in mind that as you're getting close to that 1%, you really need to think about closing the trades. So hopefully that is a bit clearer, but I wasn't quite sure what the question was. Yes, so another individual has asked, yes, you're measuring previous retracements and previous impulse waves. You're not measuring the last one, but you're measuring all of them. So for example, as you are trading more and more, and you've been trading a week and 2 weeks and 3 weeks and 4 weeks, you're having more and more data. But of course, you're going to take into consideration the average as well, which is going to take all of that into consideration. Because, for example, if you're looking at 2 impulse waves, the average of those 2, but another trader is looking at an average of 50 impulse waves, that second trader is more likely going to be more accurate. Another individual he's saying, okay, so I can see now there's more benefits to entering before the retracement. Okay, yes. I've got another question here. Can I have a recording of this? Just so everybody's aware, the recording will be uploaded on YouTube, and also the recording will be sent out to everybody as well. Another question, sometimes stocks are temporarily disabled on the HFM platform. Keep in mind, ladies and gentlemen, that stocks are related to, are of course limited to the stock market opening hours. So for example, if you're trading a stock which is within the NASDAQ, it could be Apple, it could be Microsoft, for example, then of course, they're only going to be tradable during the US session. If you're trading though, for example, Adidas, which is a German stock, then of course it's going to be limited to the German market open. I've got an individual who says not too sure how to measure the price movement. So I'll show you that at the end of the webinar. We can look at it on the MT5. So another thing, ladies and gentlemen, the impulse wave. Why do individuals say to concentrate on the impulse wave? And why do individuals, and again, I'm using this because I can see a lot of people are asking questions on this. Why do a lot of people say that the second impulse wave is most beneficial for beginner traders? So there's 2 parts, ladies and gentlemen. The first one is the impulse wave. What is the impulse wave, did we say? The impulse wave, ladies and gentlemen, is the wave in the direction of the trend. So because in the previous slides, we're looking at larger trends, I've changed the stance slightly here, and we're looking at a 15-minute time frame. So it's a bit more intraday. So impulse wave is the wave in the favor and the direction of the trend. So this is a wave in the direction of the trend. This is a wave in the direction of the trend. This is a wave in the direction of the trend. Then you have retracements. This is a retracement. This is a retracement. This is a retracement here, ladies and gentlemen, as well. And also, this is a great example as well as to why breakouts can be difficult a lot of the time. If you're trading a breakout here, or if you're trading a breakout here, you can see you're missing most of the price movement. Look at this here, for example. If you're trading a breakout here, ladies and gentlemen, there's very little price movement for you to take advantage of. Whereas if you're looking at taking advantage of the price movement down here, you've got half an hour of price movement in order for you to have traded and closed the trade, especially half an hour for those traders and ultra short-term traders and scalpers, for example. So impulse wave, we've determined that the impulse wave is in the direction of the trend. A lot of people that I spoke to during last week's webinar were trading against the trend. They were saying the price of this asset is too expensive, the Nasdaq is too expensive, it's going to decline. I'm going to speculate with decline. Yes, the Nasdaq is very expensive. Maybe is indeed going to decline, but you're not building a portfolio. You're trading on leverage, so the trade timing is very, very important. In order for you to speculate that decline, you have to be trading at the right point. There's no point in saying the Nasdaq is very expensive, it's going to decline. If it's going to decline in 30 days time, if you're going to trade today, you need it to decline today. More importantly, you need to decline imminently. There's no point declining after 12 hours or 24 hours. Ideally, you want to trade and for the price to move in your favor straight away. So individuals, they say, especially professional traders, they say beginners have more benefits if they concentrate in the direction of the trend. Of course, it's completely down to you how to trade. You can trade against the trend if you want to. But think about it this way. In a trend, most of the price movement is in the direction of the trend, if it's going to be a trend. So if you have a dice has 6 sides, but let's say there's only 2 numbers. Let's say 4 sides have the number 1 and 2 sides have the number 2. If you roll the dice, are you going to bet that it's going to land on the number 1, or are you going to bet that it's going to land on the number 2? Of course, you're most likely going to bet that it's going to land on the side where most of the sides have that number. And the same thing applies to a trend. If you're going to trade in a direction, then of course, if you're trading in the direction of the trend, there's a higher possibility that the trend, the price movement is going to move in that direction, unless you're trading at the end of the trend. So this is something for you to take into consideration. People say to me, what side, or, how should I be traded? Should I trade the retracement? Should I trade the correction? The price is very expensive. Should I speculate that it's going to decline? And the answer to the question, ladies and gentlemen, without giving advice, a lot of individuals within the market, they say there is benefits to trading in the direction of the trend. But it is important, what is also important is the timing. Now, if you're going to say to me, within the trend, which is the most beneficial area to be trading, then another theory is known as the second impulse wave theory. And this theory, ladies and gentlemen, says the most beneficial impulse wave to be trading is the second impulse wave. And why is that? Let's say we've got a down price movement like this, ladies and gentlemen. And then we've got the trend forming like so. So which impulse wave is the easiest, should I say, the most beneficial to be traded? Individuals and the theory, the second impulse wave theory, states that this second impulse wave is the most beneficial for traders. Why is it the most beneficial for traders? Because, ladies and gentlemen, the issue with this first wave, so this is the first wave here, ladies and gentlemen, the issue with the first wave is it's the first impulse wave. So before that, there was a completely different trend. So it's the first time the price is moving and forming in that direction because it's the first impulse wave. So in order for you to be trading there, most likely in your mind, you're going to be thinking, I'm trading against the trend. I really don't want to trade against the trend. Most people here watching today's webinar will say to me, I'm not comfortable about trading against the trend. I'd rather trade in the direction of the market, which is understandable. So this is the issue of the first impulse wave, because it's very, very early on. You're trading before the trend has even formed. Now, the issue with the third impulse wave and the fourth impulse wave, keep in mind most trends, and of course there is exceptions, ladies and gentlemen, because for example, if you look at the NASDAQ, it was increasing in value for 5 consecutive weeks. So if we look at the four theories, such as the Wolf wave theories, such as the Elliott wave theories, the impulse waves on average tend to be 3 or 4. So if you're trading on the third impulse wave, you're trading towards the end of the trend, in which case there's risk there. So this is why a lot of people, they say, especially individuals looking to educate themselves, individuals, for example, today that are trading on the demo account, look at the second impulse wave, because there's that advantage there, ladies and gentlemen, that you are trading in the direction of the trend. You're not trading too early that you're trading before the trend has even formed, but you're not trading too late that you're running the risk of the price being oversold. Improve the direction, ladies and gentlemen. This is something which is very, very helpful as well. Let me look at today's, the questions here. So I've got an individual who says there's news being released and it's mixed results. What am I expected to do? Look, again, I can't give you advice on what you're expected to do. What I would say is look at the price movement, look at the direction of the market, look at what we're referring to today, for example, as well. Don't trade just based on news, because you're excluding everything else which is affecting the price from your analysis. Look at what we're looking at today's market. Measure the retracements, measure the impulse waves. This is also very important as well, because you're referring to stocks. So how can you improve the direction, your trade direction? This here, ladies and gentlemen, is the top 20 most influential stocks within the NASDAQ. This information is available to everybody. You just go to Google and type in NASDAQ components. You can type in S&P 500 components. You can type in Dow Jones components. Now, why is this important? Because all these indices, they are what is known as a weighted index. Now, a weighted index, ladies and gentlemen, means that each stock within the index has a certain weight, it has a certain level of influence. So let's say, for example, if there's $100,000 within the NASDAQ, you can see here it says weight, and this is weight in percentage. So 11% of the 100,000 is made up of Apple stocks. Whereas if you look at the 20th most influential stock, Comps down here, it's only 1.16%. So out of the 100,000 stocks, only 1,160 is invested in Comps, whereas we've got more than 11,000 invested in Apple. So what does this mean? This means that Apple, because it has a higher weight, is more influential than Comps. Microsoft, which has a higher weight than Amazon, so you can see here, for example, Microsoft, let me get my laser out so it's easier for everybody to see. Microsoft here has 10%, whereas Amazon has 5.6%. So Microsoft is more influential than Amazon, and so on and so forth. This is showing what percentage, what influence they have over the NASDAQ. Now, when we're looking though at indexes, it's impossible for you to analyze 100 stocks. It's impossible. So what individuals do is they look at the performance of the top 20 most influential stocks. Now, there's different theories. Some people look at the top 5, some people look at the top 10, some people look at the top 20. It's down to you. This is here for educational purposes only. And what how do people understand and use this to improve the direction that they're speculating? This is an example, the 15% rule. This is a very well-known rule within Wall Street, where they look at the top 20 most influential stocks, and they say to them, sorry, this is an example here. It's actually the 80% rule. So they look at the top 20 most influential stocks, and they say if 80% of the top 20 are declining today, then I'm using that as an indication that potentially we're bearish on the stock market. If 80% are all green, then they use it as an example, as an indication that we're looking at a bullish market today. So of course, when you're looking at a bearish market, you're looking to speculate potentially that the price is going to decline. When you're looking at a bullish market, potentially you're looking to speculate the price is going to increase. So here, for example, look at all of these reds. Look at all of these reds. 85% of the NASDAQ is in a red before the market has even opened. So is anybody going to invest and buy, or is everybody going to speculate that the price is going to decline? By the way, this is an example from a few days ago. And by the way, when I took this screenshot, it was one of the worst days the NASDAQ had in a very long time. So this is something everybody can do day after day after day. Last week in our webinar, we said before the US market opens, look at the performance of the European stocks, look at the performance of the DAX, look at the performance of the French CAC. If they are performing well, then you can use that as an indication that the sentiment in the market is good today. This is another example. In addition to looking at the DAX and the CAC and European stocks before the US stock market opens, go to Google, type in NASDAQ components, it will show you this. You can see how they're performing here. For example, here you can see the top 10 influential stocks are all declining. And again, you can use this as an example. Now, another thing that you can do to improve your trade timing. I've got more questions here, ladies and gentlemen, but we're running late because we've been speaking now for 48 minutes and we want to be done within the hour. But let me quickly read this. Can we get a PDF with the PowerPoint presentations? Yes. I've got a question here from a gentleman about the Osmond tool. We'll look at this in a moment because it's not necessarily related to this slide. So another thing, ladies and gentlemen, is conflicting signals. Look at 2-3 time frames to get an overall picture. What 2-3 time frames do you believe is needed in order for you to get a good picture about what is going to happen within the market? Is it going to be helpful for you to use a 1 minute and a 5 minute and a 10 minute? Would that give you a big picture? It's up to you. I'm not going to answer the question for you. But do you believe it will be more influential and beneficial if you use a 2-hour time frame and a 5-minute time frame and a 15-minute time frame? So you've got a medium-term time frame, 15 minutes an intraday time frame, and 5 minutes a short-term time frame. Would that give you a better picture? And there's a couple of things for you to be looking at. Make sure that you're using the appropriate time frame. So if you're looking to open the trade and close it in 5 minutes, you're looking at the monthly time frame. It's not going to be very beneficial for you. Avoid conflicting signals. When there's conflicting signals, the signal is weaker. This is what is known within the financial trading markets. So I'm going to give you an example of this on our next slide. This is something very helpful, ladies and gentlemen. So here we're looking at the German DAX, which on the platform is the German 40. So most traded German equity. includes stocks such as, for example, alias, such as Adidas, which some of you may know. Here we've got a 2 hour, and here we've got a 5 minute. So it's something similar to what I said before. We've got a moving average here, and we've got an oscillator here. We've got the relative strength index. So what are we seeing here, ladies and gentlemen, on this slide, on the 2 hour, the German DAX? We are above the 140 bar moving average. This, ladies and gentlemen, is telling us that buyers have control of the market. This is what the indication is. Of course, doesn't mean if it's above, buyers are always going to control the market. It's just going to continuously non-stop increase in value. But generally speaking, it's in that area that we get an indication that potentially we should be looking at opportunities to buy, because buyers are controlling the market. Most of the price movement is upwards. The oscillator is between 50 and 75. So again, we have an indication that buyers are controlling the market. So we switch on to a 5 minute time frame, ladies and gentlemen, and we look at this indication here. Look at this indication. Hopefully people can see this red circle here. So now we've got two moving averages. We have a 14 bar moving average, simple moving average, which is the red line, and we've got the yellow line, which is an 8 bar exponential moving average, so an EMA. And what you can see is that it keeps crossing over. The yellow crosses over downwards. It's deemed to be a potential indication that the price is going to decline. It crosses over upwards. It's deemed to be a potential indication that the price is going to increase in value. So we have a downward crossover there. We also have a downward crossover here. So you can see the yellow crosses downwards here as well. But if we look at here, ladies and gentlemen, we have indications here the price is going to increase. This is just an example. If we look at, for example, here, ladies and gentlemen, if we look at a stochastic oscillator, we have an upward crossover here. So it's an indication the price is going to increase. Okay, it's a stochastic oscillator, so it's deemed to be a weaker indication, but nonetheless, it is an indication. Here we've got another upward crossover. So even though we've got downward crossovers on these two occasions, on one occasion here and on another occasion here, we've got on the 2 hour indications the price is going to increase, and we've got upward crossovers on the stochastic oscillator. So this is where we have conflicting signals. Whereas, ladies and gentlemen, if we look at the 2 hour, we have, like we said, indications buyers have controls. And if we look at this indication here, is an upward indication. The next upward indications here where it crosses over upwards. Potentially, these could be used as indications. Look at this price movement here. Look at this price movement here. Much more healthier price movement, much more healthier signals. Whereas when we looked at conflicting signals, here we did see some price movement increase. It did decline in value for 20 minutes. So if we were scalping or ultra short-term traders, it's okay. Here though, it didn't move downwards in any way, shape or form. So you can see here that to improve our time and to improve our direction, to look at, to avoid conflicting signals, but signals that align on both time frames. So here, for example, we're looking at alphabet stocks. So here we've got a 1 hour time frame. This time I'm using a 75 bar simple moving average. And here we're using the same moving averages as before. 14 bar simple, which is the red, 8 bar, which is the yellow. So we have a crossover downwards here. And also the price is below. So you can see here the price is below. So this is not a conflicting signal. And if we look at the stochastic oscillator in this area, we're below the neutral as well, which is also potentially another indication that the price potentially may decline. It's not guaranteed, it's an indication only. Next signal, this signal down here, we're still below on the 1 hour, and we've got another crossover downwards here. You can see on both occasions, the price moves in the direction of the trend, in the direction of the signal. So you can see here, ladies and gentlemen, the benefit of avoiding. Can you send the presentation? Yes, of course. Of avoiding the benefit of avoiding conflicting signals and to be using the right time frames, different time frames that will give you a clear picture, an overall picture. There's no point looking at 1 minute, 2 minutes, and 3 minutes. It's going to give you very similar pictures. And making sure all signals are pointing in the same direction. So bear with me, ladies and gentlemen. Some people wanted to look at the cross tool. So I'm going to stop sharing my slide just for a moment. And we're going to go to the MT5. Bear with me. I'm going to share my screen now. If anybody has any questions, of course, they can ask. So hopefully everybody can see my screen now. Yes, okay. So this is the cross tool. So let's say I want to measure the retracement, the impulse wave in the direction of the upward trend. So I'm going to the low and I go to the high, which is this is the high here. So in terms of percentage, it's 0.39. It's 413 points, which is 41 pips. Let's change the asset. You can look at another impulse wave. So for example, here, let's actually measure the retracement this time. So we've gone to the low, we went to the high here. So 0.43%. So hopefully that, ladies and gentlemen, shows you exactly how you can measure on the MT5 like I promised. Any other questions, ladies and gentlemen? So I've got an individual who says, can you show me how to measure? Just shared my screen. Just let me know if that was okay. She's already replied, so thank you. Thank you very much. Hopefully today's webinar was educational, ladies and gentlemen. I'll give a couple of seconds if you have questions, otherwise we'll end the webinar. And of course, each webinar is going to be based on different aspects of the market. Some webinars we may be looking at strategies, others we may be looking at methodologies of analysis, about timing, about risk management, trading plans, more advanced aspects of the market as well, such as order flow analysis. If you've got some time to do some research yourselves, you can of course research order flow analysis, which is slightly more advanced, but very, very helpful. Okay, so I can see everybody saying goodbye. So let's end today's webinar. Trade safe, ladies and gentlemen, trade responsibly, and hopefully we'll see you very, very soon on our next webinar. In the meantime, goodbye.